Okay, I am live with Cherry Chan, Chartered Professional Accountant, CPA, and Cherry specializes especially with working with real estate investors and small business owners and entrepreneurs in Southern Ontario. Correct, Cherry?
Yep.
Okay, so today I'm sitting down with Cherry specifically to ask her about the top deductions for real estate investors. So we'll just go down the list and I think call out the documentation for each deduction as well that you want to hold on to.
Oh, absolutely. So I think in a previous video that we did together, we talked about the general deductibility rule. So I want to make sure reiterate that in the Income Tax Act, you are allowed to deduct any reasonable expenses that you incur for the purpose of earning a particular source of income, and subject to a bunch of exceptions. So the key here is to be able to establish the cause and effect relationship between incurring the expenses and earning the income. Then you would be able to maybe have a chance for deduction. So understanding that is important because you don't know all the detailed rules, but as long as you would have that, you are able to prove that cause and effect relationship, you may have a chance for a deduction, to earn your deduction.
So if you're thinking, can I deduct this? You just have to think, can I establish a relationship between this expense producing income from my rental property?
Exactly. That's exactly what it is. Now, leading from there, the second key note that you need to remember, if you are able to establish the cause and effect relationship, you need to keep the receipt. So all the receipts are very important. If it is Home Depot receipt, we know all the Home Depot receipts, they are notorious for fading away after 1 year of keeping them. So make sure you keep the legible receipts. You can take a picture of them. Soft copy is acceptable as long as you keep the soft copy and it is legible. So keeping the receipt is also the second rule. The third rule that I have is stemming from that cause and effect relationship, some of the common expenses that are very easy to understand is utilities of your rental properties would be deductible. You need to keep the utility receipts. Nowadays, you can...
What if your tenant's paying the utilities?
Well, then that's not deductible, but there would still be utilities billed between changeover of your tenants. So those would be deductible as well. Utilities bill, internet bills as well if you provide internet. Then there would be property tax, mortgage interest. So with respect to mortgage, make sure that you maximize the mortgage interest deduction. If you are refinance the property during the year, it's important to make sure that you're also deducting the first mortgage interest for the first mortgage before refinancing. Typically, our clients miss that. There's a property tax. Keep your annual property tax bill. And then there is also property insurance. You pay for the property insurance, keep the insurance document. So it would help you to establish your case for deduction. Some of the lesser known expenses that you could also deduct that would include repairs and maintenance is a huge one because people often confuse capital improvement with repairs. Capital improvement, improving the property, extending the life of the property, the expenses that you incur on capital improvements are not tax deductible as a one-time expense against your rental income. It can be added to the cost of the building. So if you purchase a property for $500,000 and you spend $100,000 on capital improvement, now the cost of your adjusted cost base, so your adjusted purchase price is $600,000. Eventually, when you sell the property for $1 million, you can deduct $600,000 instead of $500,000. So those receipts, you have to keep it forever.
So those tax savings you get when you sell the property.
Yeah, you don't get the deduction until 10 years, 20 years down the road when you sell the property. And it's worthwhile mentioning, you have to keep those receipts forever, literally, because you're not going to get audited until probably when you sell the property. And 7 years after you sell the property and report the capital gain, CRA still has the right to come back. What
are some of the major things that would fall under that capital improvements category?
So it's sometimes a gray area, but some of the easier example would be if you buy an older property. So you buy an older property and you knew that you have to spend $100,000 to upgrading the entire property immediately after closing, then that $100,000 would be considered capital improvement. If you purchase a property and the basement is completely empty, so it's not gutted, it's just empty, then the improvement that you made, the renovation that you made in the basement, putting in the extra kitchen, extra bathroom, extra bedroom, those are all capital improvement. And so you would have to add it to the cost of the building.
So is it typically major renovations?
Yeah, major renovation would be one of the determining factor.
Okay, but the little odds and ends and little kind of handyman fixes around the property, not so much.
But it goes back, there are special rules around that too. If the handyman stuff are happening again immediately after you purchase your property to get the house ready for rent, then that would be considered capital improvement as well. If the handyman services that you do to get the house are incurred for you to get the house ready for sale, the expenses are again part of your purchase price rather than part of your repairs.
So what about just like painting the house?
And the same thing, if the painting the house immediately after you purchase the property would be considered capital improvement. But painting the house in between tenancy is considered it's considered a current expense. You can write it off against your rental income.
Weird. Okay, because it's the same thing.
Yes, it is. That's why it's complicated.
Yeah.
Yeah.
Okay. Are there any other deductions for real estate investors that
absolutely. So some of the lesser known one is the line of credit interest expense. A lot of us start our real estate investment journey by tapping into the home equity of our own home. All of our homes have appreciated a ton. We typically go to the bank and they would offer us a line of credit against our home. The interest related to any investment, to generate any investment income, would be tax deductible. So if you borrow against your home equity line of credit and use the fund to purchase a rental property, the interest on that portion of the loan would be tax deductible. So make sure you keep the line of credit statement.
Okay. It seems like just keep anything related to your properties, right?
Everything, yes.
Yeah. Have you seen it come back to bite people that haven't kept some of those crucial?
Oh, yeah, absolutely. I've seen so many people being disallowed because they don't have the proper receipts. I have clients clients being audited by CRA asking for receipts, and they deduct the expenses, but they actually pay the contractor cash. So they never properly got the receipt.
Yeah.
Yeah. And then they came back with a made-up receipt, which looks exactly identical for a lot of them. And I'm like, that's not acceptable.
They Googled invoicegenerator.com and just made up all these invoices.
Exactly. Yeah.
Okay.
Yep.
Anything else?
Oh, yeah. So there's automobile expenses, home office expenses. If you own condos, so condo fees would be tax deductible as well. And then there is also bank charges. If you also have a real estate membership, similar to the Rockstar membership, you are eligible to deduct it as long as you can prove that there is a cause and effect relationship. It actually helps you generate more rental income, then you would be eligible to deduct it. And those are pretty much all the deductions that I could think of.
Okay. And then just for bookkeeping purposes, store everything, record it as it comes in.
Yes.
Add it all up, send it to your accountant at tax time.
Yes, exactly.
And then that all gets deducted against your rental income for the year.
Some of them would not be tax deductible. Some of them may be tax deductible. So make sure that you have certain conversation. Remember when we first started, it was the general deductibility rule. And we talked about earlier about the beer situation. Yeah. If you buy beer or buy any gift cards for your tenants to use to help you pay build better relationship with your tenants. A lot of the time our clients would buy a Starbucks gift card or Tim Hortons gift cards to the tenants as a Christmas gift. They're deductible, but the problem is that they're with restaurants. So all the music and entertainment are only 50% deductible. So if you spend $100 on the gift card, only $50 is tax deductible.
Okay, so buy a gift that's 100% tax deductible.
Yeah, so if you go to amazon.ca, not that I support Amazon. Every time I talk about gift card, people attack me online and say, well, what about the small business out there? Well, support all small business, but it has to be somewhat relatable to your tenant as well. Make sure you document the tenant's name, who received it, and why he's receiving a gift card. It's maybe Christmas time, you're giving your tenant or your client, in this case, gift card, and document it and make sure that you have that, because CRA would also look and check.
Okay, so Amazon is 100% tax deductible?
100%, yes.
Oh, okay.
Well, provided that you are truly gifting it to your tenant.
Of course, yeah, if you actually are. Okay. Am I missing anything? I think that's about it for top deductions.
Yeah, absolutely.
Oh, one thing. When I first started out, I wasn't clear on the language about writing things off. People would be like, it's a write-off. It's a write-off. So, first starting out, I just thought, that means you can like completely write it off, like it's not an expense at all. And like, let's say the $100 Amazon gift card, you get that $100 back at like tax time or whatever. That was my kind of naive thinking. So can you break down how it actually works? Like, how do deductions actually function?
Absolutely. So typically, if you get rental income, let's say $2,000 a month for the full year is $24,000, assuming it's rented consistently, you deduct the expenses. You deduct all the eligible expenses. Let's say it's $14,000. So $24,000 rental income minus $14,000 expenses, then you are net with $10,000. That rental income is going to, the net rental income is going to be subject to your subject to tax. Now, if let's say you get another invoice, your contractor give you another invoice for $1,000. If it is a deductible expenses, instead of $10,000 being taxed, now it's $9,000 being taxed. So when you, some business owners, when they say, hey, I could just spend another $20,000, it doesn't to get the write-off so I don't have to pay tax. The reality is that there is still a true after-tax cost, because the tax is only a portion of it. You're only going to get taxed. Majority of us would be taxed at 30%. Or sometimes 40%. So if you have a net income of $10,000, then you pay tax on $4,000. But if you have an additional $1,000 expenses, it's only going to save you for 40% of that $1,000 as tax. So you're only going to save $400 of tax. So it's not $1,000 of expenses save you $1,000 of tax. It's $1,000 of expense saving you $400 of tax.
Because you tax on the net income.
Yes, exactly.
So there's no world in that which expenses are a good thing.
Because there's also true after-tax costs.
Yeah, like you don't want to rack up expenses for the sake of taxes.
Yes, exactly.
Because let's say you're in that 40% tax bracket, you're still paying 60% taxes on the 60% of that expense.
Exactly.
Okay.
Yeah. Actually, I just finished reading a court case. That's how I fall asleep every night. I'm just kidding. But I just finished reading up a court case about a company who intentionally rack up a bunch of losses. Expenses or losses just so that they could not pay tax. And CRA was attacking them. And then ultimately, when they take the case to the Supreme Court of Canada, the court sided with CRA. So they created this huge law so they don't have to pay tax. And then next year they recognized a bunch of gain. And then they created another huge loss at the year end to offset the gain and create bigger losses. So they didn't pay tax for many, many years.
Jeez. Okay.
Yeah. So it's not a good thing.
Yeah. Moral of the story, keep things simple.
Yes.
Keep the income up, the expenses down.
Exactly.
And deduct as much things that actually related to you producing income as you possibly can.
And legitimate expenses.
Exactly. Yeah.
And keep the receipts as well. Just because your contractor offer you no tax doesn't mean that you should really pay. You should pay cash. And
keep everything. Refinance paperwork, line of credit, statements, everything.
Absolutely.
Okay. Awesome. Thanks, Cherry.
Thank you.